All right, hey y'all, it's John, and today we're going to talk about the best index fund investing strategy. This channel is about saving, investing, building a life of abundance, building wealth, and index funds are one of the best ways to do it. But before we get to it, I think I need to explain some things to get up to what that strategy actually is. So I will put chapter markers down below. If you want to skip some of the basics, you can go straight to the strategy, my 3-bucket rule. Otherwise, the first thing to do is to understand what a stock is. Now, we use the term, we know the stock exchange, for example, companies have stocks. I want to buy stocks. Wall Street Bets talks about stocks all the time. And, personally, I'm not a fan of individuals like you and me buying individual stocks. The stock markets are really dominated by retirement plans and institutional investors like that. You and me are not really having an impact out there. Now, certainly I use Webull, invest a little bit, and you can go get your 2 free stocks when you sign up at Webull at the link below. But I look at that more as gambling, more as money I'm willing to lose just to own a stock in something I actually kind of care about. But what is a stock? And the short answer is it's a share in the ownership of the company. You have a vote in things that are brought before shareholders. Say you start a company and you build it to $10 million in revenue, and you decide to go public and you offer 10 million shares. That means every share is worth $1. Now, it's a lot more complex than that. I get that. It really, really is. But that gives you a point of starting to understand what it means. Those shares mean that you have that 1/10 millionth of a vote on things. Now, a share price is not just what's the revenue versus how many shares are out there. It also reflects the optimism or the lack of optimism around a company. If you have a large blue chip company like, say, Coca-Cola, leadership's been in place, it has a century of good decisions and moving forward and strong selling products and expanding into new markets and expanding into new areas, like when they moved into water, things like that, then the optimism of where that company is going, does it have new markets to move into? Does it have new products in the pipeline? Can they streamline things and save on their expenses? That's reflected in the price as well. And you see that in some companies like Tesla, that even before they were really profitable, their stock was doing okay. And the more profitable they get, the more their stock goes up. Well, similarly, if you have a company that is really being battered with bad news, the CEO resigns, there's scandal, there's, look at car manufacturers, and you see them every once in a while, they have a let's say a recall scandal because they tried to hide things from regulators. That can really put a damper on the stock because it has to be worked through. So the stock price varies a lot and reflects that optimism or lack thereof. And that's why I don't think that individuals should really buy individual stocks. You think about these big firms like Edward Jones, for example, or any other number of other ones, and there's professionals in there who went to college, they were trained on this, they have tons of experience, and their job every single day is to look at a company or companies, the products, the competition, prices around the world, oil, materials, weather, all this other stuff, as well as that leadership of a company, and determine whether the stock's a good buy or not. Well, the fact of the matter is they're often wrong, and if they are right, they can't be right year after year many times. So what makes you think that coming home from work and spending an hour on Google, you're going to get more information than them? Sometimes it works out, and we love those stories where people make a ton of money by buying a stock, but more often than not, if it's not a buy and hold strategy of a company you love and a company you know, it's gambling. That's all it is. Buying a stock like that is not putting all your eggs in one basket. That's literally just owning one egg, right? So that leads us to a mutual fund. And a mutual fund is a collection of stocks that you buy into, right? That's the basket of stocks. And you aren't buying the individual stocks within it. You're actually buying a share of that mutual fund. There are hundreds or thousands of different mutual funds out there. Some of them are actively traded, and they all have some kind of criteria they're aiming for. Maybe it's a growth mutual fund. Maybe it's a small cap growth mutual fund. Maybe it's a large cap value fund where they're looking for stocks they think are slightly undervalued. Those are actively managed, where there's one of those professionals over here actively moving stocks around, balancing things, and trying to get the best return. Like I said, those guys do their best, and every once in a while they hit a home run, but year after year after year, they cannot consistently beat the market. An index fund like an S&P 500 index fund means you're not trying to beat the market. Why not just invest in the market? And the fact is if those actively managed funds cannot consistently year after year beat the market, well, by trying to beat the market, you're actually losing more value. So just invest in the funds. Now, because index funds seek to just index something, they're not actively trading, your fees, which you have to actually pay to stay involved, are much, much lower. I think mine, S&P 500, I think the fee is something like 0.03 or 0.05%, whatever it is. It's really, really small. Regardless, an index fund just seeks to track the market. And a mutual fund, you can also get index funds that are ETFs. We're not going to get into that here, but a mutual fund is just that package of stocks. Now, there's tons of mutual funds out there. If you want a mutual fund that invests in energy stocks, if you want a mutual fund that invests in green energy stocks, they all exist. You can really get specific with mutual funds, but we want to focus on just three, because here's the strategy. Moving towards retirement, looking towards building wealth and building that sense that you too can be a millionaire in America, there's a basic three bucket strategy that I use. 3 index funds that you put your money in consistently, let it grow, forget about it, use time on your side, and you can grow to staggering amounts of wealth. I've had videos on this channel where I've talked about a $200 investment and what it can grow to in 40 years. But what are those three index funds, those 3 stock funds? The first would be an S&P 500 index fund. So that's going to take 500 of the largest companies here in the US and just invest in them. Boom, we own them, and now we're letting it move forward. You're literally tracking 500 of the biggest companies in the market. So if Pepsi goes down a little bit, but Coke goes up, you're still benefiting. If GM drops but Ford goes up, you're still benefiting. You're not gambling on one or the other within a marketplace. Those are the big stocks, though, and a lot of times, not all the time, but a lot of times those big stocks are looking for incremental growth. You're not getting the huge chunks of growth. So the second one I recommend would be something like a small cap index fund. The smaller companies that may be more innovative, maybe more nimble, really can have bigger growth. And then the final one would be an international index fund, because how the economy is doing around the world can vary. If America and Canada are doing very well, maybe Asia's a little depressed. If Europe's doing well, maybe America's down a little bit, but China or Southeast Asia is doing real well. These international funds can capture some of that innovative growth, and that's a super exciting area to be in right now with the strength of Chinese economy and parts of Southeast Asia and to a lesser extent even Japan. So my 3 bucket strategy is real simple. An S&P 500 index fund, a small cap index fund, and an international index fund. Now, I've shown you the ones from Fidelity. I've chosen to use Fidelity, and I've made a commitment on this channel that as we grow and as we as a community build this channel to profitability, to paying payouts on the YouTube Partner Program, I'm going to take any money, at least initially, I'm going to take any money I'm getting from YouTube and I'm going to put it into my Fidelity app. I'm going to put it into exactly this 3 bucket strategy and allow it to grow and show you every single month how it actually is working and that it does work. The nice thing about it is once you put it, it's set it and forget it. Don't track it. Don't look at it every single day. Don't stress over the little ups and downs. you're not trying to do that. You're not trying to time the market. You're doing what's called dollar cost averaging. You're literally just buying and holding. And so honestly, even if we have another recession and I can still buy, I'm not going to sell because you don't realize losses until you sell. So just let it go, buy through the downturns and let it ride up. So there's your 3-bucket strategy, a basic investing strategy to build wealth with index funds. I hope this helps. If you have any questions, please don't hesitate. Reach out to me below. If you like this content, please consider subscribing to this channel and please give me a thumbs up. It really helps me.